Hey everyone, it is David Trungale with TraderTours.com. Thank you for joining me. And today I wanted to talk about buying call options and explain why you can get into trouble very easily with this particular strategy. And I also wanted to debunk this idea that low risk, high reward investments are always a good idea. Because it sounds like it would be. Mitigating risk and maximizing reward is something that, myself as well as just about anyone I know, they would probably tell you it's smart, but you have to consider probability to really get the complete picture. And probability is what separates a lot of the top traders out there, and it's exactly why low risk, high reward investments are not actually a good idea in certain cases. So let's talk about this. First of all, if you don't know what a call option is, buying one call option contract gives you the right, but not the obligation to buy 100 shares of a stock at a specified price. We call that the strike price, and that is on or before an agreed date. I manufactured a little example here, real world example, to try and make more sense of this. So suppose someone is selling a used car for $1,000 and you offer them $50 to hold the car for you over the next 30 days. What has happened here? Well, a call option has essentially been established. The seller has agreed to honor the price of $1,000 for you, and you, as the buyer, have 30 days to decide if you want to actually buy the car. And regardless of what happens, the seller is going to keep your $50, but within the next 30 days, you can either buy the car for the guaranteed price of $1,000 or walk away. All right, so does that make sense to everyone? If we look at this, the $1,000 is what option traders would refer to as the strike price. The $50 is the premium that you paid, and we know that's non-refundable, so that's the cost of the contract. And the time frame is going to be 30 days. Okay, those are the variables of this contract. Now, keep in mind that in this example, I brought up a used car, and we pretty much know that cars have a track record of going down in price as time goes on. So after 30 days, the price of this car would be $1,000 or less. That's pretty much a guarantee. But when it comes to buying call options in the stock market, stocks have a nature of going up, don't they? They also can go down and sideways, but the point is there is volatility. And this is why people are trading these options, because they know that the markets fluctuate and stocks can go up, down, and sideways, and they do it every single day. All right. So let's look at an actual stock, Verizon Communications. Most of you guys, I'm sure, know of this company. And let's look at some call options on it. Now, I'm going to really exaggerate this mistake to make a point, but we can see that Verizon currently has a market value of $49.90. That is the share price of the stock. And suppose someone bought a call option with an expiration of October of 2017. So that's 1 month away. And if they bought this call with a strike price that's out of the money, it would be anything higher than $49.90. Because they're buying the right to buy Verizon at a price that is higher than what the stock is currently selling for. So they're pretty much speculating that this stock is going to go up, and it's going to go up a lot. And let's just lock in 65. This is super outlandish, but bear with me here. I want to show you guys the trade calculator. So you're locking in the right to buy Verizon at 65. And at first glance, a beginner might look at this and say, wow, this is great. Your cost basis is only $1. That's the most you can lose. Because the premium was a penny times 100 shares, that brings the net cost to $1 plus commissions. And if you look at the profit and loss column, you can see, wow, if Verizon went way up to $81.25, you would make 162,400%. And that number is not fabricated. You would literally make that return. If you bought 1,000 contracts, you would be risking $1,000, and you would become a millionaire if Verizon went to $81.25 in 30 days. The problem with this is probability, okay? And this is why low risk, high reward investments don't always translate to being a good idea, because that's exactly what this is. You're not risking much. I mean, $1,000 isn't much to most people, or $1 certainly wouldn't be. And the reward is very high. But what are the odds of this happening? I'm telling you right now, slim to none. And in fact, if you look at the strike price of 65, which is that was the strike price of the contract. If you add the premium, which was a penny, that will show you what your break-even point was. So just to break even, Verizon would have to be at 65.01 30 days from now, okay? And the market makers aren't stupid, because we know Verizon has historically been a very slow-moving stock with not much volatility. Here's the 5-year chart. And this isn't necessarily a bad thing if you actually own the stock and maybe you get some dividend income. But from an option standpoint, I mean, this stock for the better part of 17 years, it's been nowhere near that $65 price point. So to speculate that exactly in the next 30 days it's going to rifle up to a point that it's never been to for 17 years, that's why the premium is cheap, because it's just not going to happen. And in so many words, you are putting a match to your $1,000. So this is not the type of trade I would endorse, even though there's big potential and little risk. Okay. Now, if we look at this a little differently, I guess it's technically not fair for me to call this trade incorrect, because yes, it is true that this is really the only way, or one of the only ways that I can think of to take 1,000 and turn it into this astronomical amount in the markets. You're never going to get this type of leverage with blue chips or at the money calls or in the money calls or mutual funds. So the potential is there, but the probability is not. And I think at the end of the day, the more I've been doing this, the probability is really the most important thing. Because if you think about it, the lottery, that's a transaction that involves low risk. It's only $2 to play the Powerball. And if you hit the jackpot, you could win $300 million. So the reward is huge. But the probability is horrendous, and people get suckered into playing the lottery every day, and it's a terrible investment. So learn something from this. In general, if you are going to buy calls, give yourself a chance. Buy something that has a strike price that is maybe at the money or in the money. In this case, it would be $49.90 or less. And then maybe give yourself a little more time on your contract. A month is pretty short. If you really want to reverse the tables, though, and get the probability in your favor, you could consider selling the calls. Just make sure you actually own 100 shares of the stock. We would refer to that as selling covered calls, because you would keep the premium. And what I'll do is probably make a little video on covered calls down the road. I don't mean to get sidetracked here. I just wanted to talk about basic calls and the potential problems that I see with them. So anyway, I know that was a lot, but that is basic call options. And like I said, be careful, be really careful with trying to buy calls out of the money, even though it is tempting. All right, take care.